if you are looking to expand or grow your business, add bolt-ons, potentially, bring in C-suite executives and incentivize them with equity, or partner with another individual to expand your company, this video is for you. So how do you go about that? In what situations should you give up equity? And when does it make sense? Well, in most cases, people are giving up equity for capital raising. So you see this often with startups or people that are in seed rounds, raising through private investment for more capital to continue to grow and scale their business. This is basically what the majority of tech companies do. They will, raise money to begin with to develop the technology, give up a certain percentage of equity, and then, a year down the road when they need to scale again, they need to raise more capital, they have some cash flow, they have some contracts, so that evaluation's higher, they will give away the same amount of equity for more capital. You may give away, 20% in the beginning, 30% in the beginning, and you kind of edge that off 10%, 5%, 8% as you continue to go up over time and your valuation continues to increase until you IPO. And then you walk off into the sunset or sell your company. You could sell out to a venture capital firm. There's a lot of different ways to exit when it comes to that. But as far as giving up equity in that business to grow it, a lot of the time people are doing it for capital. And that could be you too if you have a smaller business and you need more money for inventory, you need more money to bring in a certain individual in order to get their expertise or network. And that can be another reason, right? So somebody doesn't always have to make a capital contribution. You could be giving up equity to an individual that has the expertise or the network or the resources that you need in order to grow your company. And sometimes that makes sense and sometimes it doesn't. You would like to have a proven track record. You might bring that person in on rev share first. So they're able to come in, they're able to prove themselves, they grow the company, and they're able to participate in the upside on whenever they grow the company. And then at that point, maybe you offer them equity after they come in on a rev share basis. So that's something that I do. I'll consult for rev share and then move to an equity consulting position, all along while I'm charging fees for my consulting services. But if you're just getting into it, or you're trying to negotiate something with somebody and you feel that you have leverage in that capacity, then it might be wise to go that route. The other reason is you might want to share the risk, right? So if you own all the equity, you have all the risk. Let's say somebody sues you and you're 100% owner of an LLC, they can seize your bank accounts. They can lock those down. If you have partners in that business and somebody were to sue you, they can't lock your bank accounts. They can't freeze your business. They can't shut you down. So there are some beneficial reasons for having partners in a business and on your bank accounts, just from that aspect. And then how do you do this effectively, right? How are you going to determine the right time to give up equity? How do you find the right investor? How do you negotiate the right terms? And then how do you maintain communication with that person, depending on what type of partner they are, right? So timing, it's going to be tough. Everybody's going to get to a point where they have a bottleneck somewhere. And sometimes you can get through that on your own. Sometimes you can figure out how to raise the capital from a limited partner that's not going to be involved in the business. Sometimes you want to bring in a strategic partner so that they can help you work through that bottleneck. If it's not something that you enjoy doing, you're not proficient at it. So maybe you are the sales guy, okay? And you're not that great at marketing, or you're not that good at operations, or you're not that good at IT, or you're not that good at HR. There's a lot of different aspects of a business that you may not really enjoy doing as the sole owner. I'm not saying you have to give up equity for these. You can often hire these people in your business and not have to give up equity. But in certain situations, if you want to expedite growth and they have a proven track record in another area, it may behoove you to be willing to give up a little piece of the pie to get ahead. Oftentimes I see people, like I said in the beginning, that don't want to give up any equity and they want the whole pie to themselves. Well, $1 million pie is still going to be smaller than, a 10% piece in $1 billion pie. Okay. That's $100 million versus $1 million. And if you have an idea, product, or service that can be scaled to that level, you're often going to have to give up enough equity in your business in order to get there. Like if you look at Bezos, he owns, I think it's 13% of Amazon at this point, and he's a billionaire, right? But it's a $1 trillion company. So he had to give up equity over and over and over again to other people in order to bring them in and incentivize them to help him grow Amazon to what it is today. So if you think about it like that, you're looking at it from an abundance mindset instead of a scarcity mindset. Oftentimes that's going to make you, get further ahead than other people that want to hoard everything to themselves. And you want to bring in the right investor. Like I said before, this person that you're bringing in, you might stage them in on the rev share piece first before you give them equity. You want to make sure that they have a track record. You want to make sure that they are an expert where they say they're an expert. If they are a strategic partner, there needs to be reasons why you're marketing or you're merging with them. If they've got a customer base or a demographic or a pool of people that you could sell your product or service to, that might make sense. Sometimes you could acquire equity in their company and they could acquire equity in your company, and then it's a win-win because you can cross-market and you get upside when you send people to them. Those are always good situations to be in. You just want to negotiate fair terms when you're discussing this with somebody. So it needs to be a win-win scenario at the end of the day for both parties that are involved, or however many parties are involved. Sometimes it's multiple. So when you're sitting down at that table and you're drawing out those things, make sure you have clear, concise discussions and everybody understands what they're getting and why. And then that way, when you go to maintain communication in the future, there's not any animosity or any issues between you and those others individuals that are involved now in your business. So if you are the owner, as long as you have more than 51%, you stay in control. Okay, you get the final say-so on something. And that's really what matters to most people. I have seen people take money off the table, big sums of money off the table after they've grown their business to, a $100 million valuation, a $50 million valuation, hell, even a $10 million valuation. If you were able to sell off, let's say 40% or 55% of your company to a strategic investor or a strategic partner that's going to help you grow that business moving forward, then that makes a lot of sense. So you're able to capitalize on that money that you didn't have, that was going to take you another 10 years to get out of your business today to put into other investments. And you're going to get that strategic partner that's going to help you grow your business and make more money